Okay, so in this video, we will be discussing the basics of financing a business. So we have an article here from investopedia.com. So since we're talking about financing companies, what do they actually do for the businesses? Okay, how do they help? All right, so that's what we will be tackling in this video. So first, we're going to have the definition, how business financing works, and then later we will be discussing the 3 types of business financing. Okay. Let's read on. Unless your business has the balance sheet of Apple, which is a very large company, tech company, eventually you will probably need access to capital through business financing. So majority of businesses, especially small and medium-sized businesses, so they would definitely need financing. Okay, so sometimes there are a lot of people who have ideas of their own. They have these great ideas, but they do not have the capital to create a business out of it, or to put up a business and operate, to develop the product and provide an output to the market, right? So they need money, capital, or financing for that to happen. Okay, many large cap companies routinely seek capital infusions to meet short-term obligations. So on the part of large companies, so sometimes they do borrow money from financial institutions, but it's normally not to add to their capital, but simply for liquidity purposes. Sometimes their funds are tied to projects, to production, that they sometimes become short on cash flow. So, money is going to come in, but they're not yet here. So what they do is that they do borrow money, but only on a short-term basis, right, from these financial institutions to supply those needs. Okay. For small businesses, finding the right funding model is vitally important. And sometimes this would depend on, the person, the entrepreneur, or the business owner, and his ideals or principles when it comes to starting a business. So, reading on, take money from the wrong source and you may lose part of your company, or find yourself locked into repayment terms that impair your growth for many years into the future. Okay, sometimes, financing, especially debt financing, you have to pay on a regular basis, and sometimes the interest rate is, kind of high, especially if the principal is also of a high amount. All right. Okay, so first of the 3 types of financing is the debt financing. So essentially what your business is doing is borrowing money with a promise to return the money and pay the interest. So it's the same as, a personal loan or a normal loan from a financial institution. So debt financing for your business is something you likely understand better than you think. It's like mortgage or automobile loan. Okay, when you apply for a car loan, so it's pretty much the same, or home loan. Okay, both of these are forms of debt financing. It works the same way for your business. Debt financing comes from a bank or some other lending institution. So in this case, finance companies. Okay, although it is possible for private investors to offer it to you, investment houses or investment companies, this is not the norm. So how it works, when you decide that you need a loan for your business to operate, you head to the bank and complete an application. If your business is in the early stages of development, the bank will check your personal credit. All right, and then normally, majority, especially, it would depend on the amount that you're looking at. Sometimes it would depend on how much you've been earning, your history of earnings or revenue, and normally you can't get a large sum of loan from banks. So most people, they go to the second option, which are finance companies or investment companies. Okay. For businesses that have a more complicated corporate structure or have been in existence for an extended period of time, bank will check other sources. One of the most important is DNB file, a known company for compiling credit history on businesses. So in the US, they have these, but here in the Philippines, we don't have this resource yet, although there is a database that financial institutions can access to check someone's credit history. Okay, I'm just not sure if general public can have access to that. Probably not, because it's essentially sensitive information, right? Okay, where are we? Along with your business credit history, the bank will want to examine your books and likely complete other due diligence. For existing businesses, of course, they ask for tax returns and then financial statements, the audited ones. Okay, before applying, make sure all business records are complete and organized. If the bank approves your loan request, it will set up payment terms, including interest. If the process sounds a lot like the process you have gone through numerous times to receive a bank loan, you're right, because it's essentially the same. Okay, so what normally, again, businesses here in the Philippines, they require at least 2 years. Sometimes other banks or other financial institutions would require 3 years. Previous years to check the financial position and financial performance of your business. So in a way, that's one of the reasons why it's really hard for small businesses and startups, entrepreneurs, to get a bank loan for their business, because there are those types of requirements, okay, which they cannot provide since they're just starting out and they're a small business, right? So in that case, they turn to finance companies or investment companies. All right, so here we have the advantages of debt financing. So there are several advantages to financing your business through debt. So first off, the lending institution has no control over how you run your company, and it has no ownership. So it's a liability, not equity. So in a sense, they cannot disrupt your operations. They have no say on how you do your business. You're still in control of your own company or business, right? Once you pay back the loan, the relationship with the lender ends. So that is especially important as your business becomes more valuable, right? If your business succeeds, of course, as the founder or as the owner, you want to be able to have full control of the business, right? And of course, once you pay back the loan, so less liability to think about or to bother about. The interest you pay on debt financing is tax deductible as a business expense, okay? But I actually don't see that as an advantage, because essentially a business expense is a business expense, regardless of it being a tax deductible or not. The monthly payment as well as the breakdown of the payments is a known expense that can be accurately included in your forecasting model. So this is more of an internal management issue, right? Because in the balance sheet, of course, it would be a deduction from your liabilities. And then for forecasting or budgeting, then you have to include the payment of the principal for you to properly budget your projected cash inflow, right? Okay, disadvantages of debt financing comes with some downsides. Adding a debt payment to your monthly expenses assumes that you will always have the capital inflow to meet all business expenses. So it's an additional cash outflow, right? Because you have to pay on a regular basis, normally on a monthly basis. So that's going to be cash going out of your business, right? Although, of course, you have the proceeds of the loan, but you're supposed to, you expect to use that for the operations of the business. And it's kind of tricky if your business is not yet generating that much revenue. So you'll have to make sure that your cash inflow, from revenues is going to be able to sustain or cover the monthly payment of the debt, okay? Small businesses lending can be slowed substantially during recessions. So in tougher times for the economy, it can be difficult to receive debt financing unless you are overwhelmingly qualified. Okay. Currently, there are a lot of banks who have recorded a high rate of defaulted payments or delinquent loan accounts, right? Because there are a lot of businesses that are struggling. There are a lot of individuals who are struggling. So those who previously availed of their loan services, personal loan, salary loan, business loans. Okay, so there are a certain percentage of them that have not been able to pay the regular monthly payment in the last few months or so, and considering the pandemic situation, they are understanding of that, but still, it's a loss. It's a kind of loss for the banks, and I think other financial institutions are also experiencing the same way. Although banks being, I think they have 87% share of the market on financial institutions, and so they are bearing a great portion of the loss from this kind of situation, right? So in a way, because of that, they are also becoming more strict with the approval of their current loans. You have to really show that you will be able to pay them back. Okay. Okay, there's SBA here. We don't have that in here in the Philippines, so okay. I think here in the Philippines we have BMB, Barangay Micro Business Enterprises, but I did read that it's a little complicated as well. But in essence, they do provide certain avenues for barangay micro business enterprises to get loan from, as additional capital for their business. And they have partnered with some banks, especially Land Bank, being a government owned and controlled corporation. Okay, so in a way, that's the government's way of helping small businesses, BMB, Barangay Micro Business Enterprises. So I think that would be the equivalent of the US Small Business Administration. Okay. All right, second type of business financing, we have equity financing. So if you're familiar with the show Shark Tank, so essentially it's investment. Okay, instead of a borrowing or a liability or debt or loan, what happens is that there are investors who have money. Usually these are wealthy individuals who are looking at investing or providing capital to promising businesses, okay, or entrepreneurs with great ideas, right? So what they do is that they definitely review and scrutinize the pitches that entrepreneurs present to them. So what happens is, if they like the idea, or if they see that it has potential, or if they believe that it's going to work and eventually it's going to be a successful venture, then they would invest to the company. Okay, sometimes they are called venture capitalists or angel investors. Okay, what's very nice about equity financing is that you don't need to pay back the money that they're going to give you. So you can safely use them to run your business, operate your business, develop your business or your product or service. Okay, you can focus on doing those things and not be bothered by repayment terms. Okay, because these are investors, so it's an investment. You don't need to pay it back, right? But if the business becomes successful, so these people would be receiving a share in the profit of the company. All right, so let's say after 2 years or 3 years, the business is doing well. It reported a profit of in the millions, so the investors would be getting a share of that profit. So sometimes it depends on how much they finance the company for. So let's say the entrepreneur, the business owner, or the business founder pitched the idea to an investor. The investor liked it and asked to, let's say, purchase or acquire 50% interest in the company. Normally, that is, I think, the maximum that they can ask, because the 50%, the other 50% would be owned by the founder or the business owner or the entrepreneur, right? Of course, they need to have as much as that, 50-50. Okay, but sometimes they can, negotiate and lower that a bit, especially if the business owner is looking at getting more capital from other investors as well. Okay, so sometimes they do talk about or discuss how much percentage of the ownership would be given to the investor for the amount of capital that he's going to give to the business. Okay. So the thing is, let's read on. A venture capitalist is usually a firm rather than an individual. The firm has partners, team of lawyers, accountants, and investment advisors who perform due diligence on any potential investment. Venture capital firms often deal in large investments, 3 million or more, and so the process is slow and the deal is often complex. Okay, it's slow because they do review and scrutinize the idea, the business plan, the pitch deck, the feasibility study to make sure that the company is really going to make it. Okay, so in a way, it's going to take quite some time, okay, for them to do that. And then the deal is often complex because they are going to put normally a lot of money into the business. They want all the the details. There's essentially not that much secret between the business owner and the investor. They want to know everything that you're currently doing, what your operation is like. Sometimes they want to get involved in the operations, and sometimes it would be helpful in such that they would provide advice or guidance. And so on the part of the business owner, if they want to get the investors money, then they would have to accommodate the demands of the investors, as long as they're not over the top. So it's quite complex in that area. Angel investors, by contrast, are normally wealthy individuals who want to invest a smaller amount of money into a single product instead of building a business. Okay, sometimes this is for, currently what I've been seeing on groups on Facebook for app development. So there are angel investors who would like, if there's a great idea on an app, then they do connect with the individuals who are asking for capital, right, or financing for them to be able to develop that particular product, right? Sometimes in crowdfunding websites, they do have an idea for a product, and then they do ask for investors in that regard. But of course, crowdfunding is normally small amounts from a lot of people, all right, and then the return is usually they would receive the first batch of the product, or they would be the first customers, okay, to receive the particular product that they are developing, all right. They are perfect for somebody such as the software developer, yes, who needs a capital infusion to fund the development of their product. Angel investors move fast and want simple terms. So this is why angel investors are better than venture capitalists. But again, angel investors normally just for small capital requirements. For venture capitalists, this is for big scale operations. Okay. And then for the advantages of equity financing, biggest advantage, you do not have to pay back the money. Okay, if your business becomes a failure, enters into bankruptcy, your investor or investors are not creditors. You don't need to pay them back, and they are partial owners in your company, and as such, their money is lost along with your company, only if it becomes a failure, of course. You do not have to make monthly payments, again, because it's equity, it's capital, not a loan, not a liability, right? So there is often more liquid cash on hand for operating expenses. So you can use everything to operate and to fully focus on the development of your business. Investors understand that it takes time to build a business. You will get the money you need without the pressure of having to see your product or business thriving within a short amount of time. All right. Financial institutions that extend debt or loans, so of course they do earn by the interest that they charge their customers, individuals and businesses alike. But for these venture capitalists and angel investors, they're already wealthy people and they have a lot of money, excess money, and what they do is they're trying to help out the others who have great ideas, who have potential, fund their ideas and venture, right? So sometimes they do understand. Normally, they have gone through the process as well of starting their own businesses or ventures, so they do understand that it might really take a few years before your business becomes successful. So they're not going to pressure you on when you're going to pay them back, right? So if you are planning to start a business and you're soliciting capital infusion from angel investors or venture capitalists, so this is one probably a red flag if they demand that, if they demand a certain amount of return during the first year or during 2 years, or they somehow provide you with a period within which you must provide a return to him or her, then that person might not actually be a venture capitalist or an angel investor. So you might want to check again, because sometimes there would be people out there who would take advantage of people who are needing money to fund their ideas or businesses. Okay, sometimes they pretend to be angel investors but scam, and then they would harass you for the repayment, things like that, right? So be careful still. Disadvantages of equity financing. So it's like having a partner because they invested capital into your business, so sometimes they would involve themselves. Of course, not everyone would, but there would be people who would be interested in how you're doing. Sometimes they would require you to update them, let's say once a month or every time you hit a milestone in the development of your product or your business. So you have to do some reports, right? So essentially, you and the investor are owners of the company, so they have a right to actually ask for those information, right? The larger and riskier the investment, the more of a stake the investor will want. So you might have to give up to 50% of your company or more. So normally, or more, this would depend on the person. If he's not actually that, if he does not give that much importance on the ownership of the company, all he wants is to build the product and put it out on the market, something like social entrepreneurs, right? Who are more about helping other people with a product that is developing rather than the profit or ownership of the business, right? Unless you later construct a deal to buy the investor's stake, the partner will take 50% of your profits indefinitely if his share is 50%, interest in your company. You will also have to consult with your investors before making decisions, especially major decisions. You're going to consult. Your company is no longer solely yours. If an investor has more than 50%, you have a boss to whom you have to answer to. If it's more than 50%, right? Because in this sense, essentially, he has majority ownership of the business if it's more than 50%. So in a way, he's going to be your boss and you're some sort of a minor owner, right? So that's why most of the time it's only up to 50, all right? 50-50 division. All right, and then thirdly, this is the last one, mezzanine capital. So it's some sort of a combination of debt financing and equity financing. So the lender is looking for the best value for its money relative to the least amount of risk. The problem with debt financing is that the lender does not get to share in the success of the business. So normally this only happens if the lender feels that your business is doing well and that they want to turn the debt balance into equity instead, okay? So sometimes, of course, it's still a negotiation. If originally it's just a debt agreement, then later on they propose that they want to invest in your business, they want to turn the debt into capital. So if you agree, then it would be mezzanine capital, but if not, then it would remain a debt financing, right? Okay, essentially this only happens for successful businesses, right? Or those that have really great potential, and then the lender is seeing that you will be doing well in the next few years or so, and so they want a share of the profit that you're going to be making in the next few years. Okay, or in the long run, actually. Mezzanine capital, again, combines the best features of equity and debt financing. Although there is no set structure for this type of business financing, that capital often gives the lending institution the right to convert the loan to an equity interest in the company if you do not repay the loan on time or in full. So this is another scenario on how it becomes a mezzanine capital. So if you default in payment, still, it's either you're going to demand the full amount and sue you, or if they check again with your company and feel that you really have the potential and you simply need to focus on the development part of the product, then they could turn the balance of the loan into capital instead, right? Advantages of mezzanine capital. This type of loan is appropriate for a new company that is already showing growth. Okay, banks are reluctant to lend to a company that does not have financial data. Okay, that's why they normally require 2 to 3 years of financial statements and ITR. And then newer business may not have that much data to supply. Yes, by adding an option to take an ownership stake in the company, the bank has more of a safety net, making it easier to get the loan. Okay, but of course most banks do not do this. Okay, it's more for financing company, investment companies. All right, at least here in the Philippines, that's what's happened. Mezzanine capital is treated as equity on the company's balance sheet. Showing equity rather than a debt obligation makes the company look more attractive to future lenders, of course, because it would not go to the liability section, it would go to the equity section. So future lenders would feel that, oh, okay, they don't have that much debt yet, so we can extend a loan or debt to them. Okay, future lenders. Mezzanine capital is often provided very quickly with little due diligence. Okay, again, this is probably the case in the US, but nowadays not much. Okay, financial institutions have become more strict with their approvals of capital infusion. Disadvantages of mezzanine capital. The coupon or interest is often higher as the lender views the company as high risk. Mezzanine capital provided to a business that already has debt or equity obligations is often subordinate to those obligations, increasing the risk that the lender will not be repaid. Okay, because of the high risk, the lender may want to see a 20 to 30% return, which essentially what they do is, the outstanding balance would be converted into capital, and then for that amount of capital, they would ask for 20 to 30% ownership of the business, so that when they report a profit later on, they would get as much as 20 to 30%. Right? Much like equity capital, the risk of losing a significant portion of the company is very real. So this is on the part of the business owner. Okay. Again, all these financing of the business, this won't matter much to a person who really have no concern for how the sharing of the profit is going to be, if they're not that bothered by the profit sharing, right? If their concern is more about getting the product done and putting it out into the market to solve the problem that it's meant to solve, then that's enough for them. All right, and majority of entrepreneurs, that's the mindset that they have. But of course, you have your entrepreneurs that are, I don't know, who are more focused into getting profit than helping or solve a problem, right? Okay, and then you have this off-balance sheet financing. I'm not going to, although this article is saying that it's accepted in the US, I'm not sure if this is accepted here in the Philippines. because essentially, if you transact a business transaction like getting a loan or getting a capital, you have to reflect it on the financial statement of the business, right? Okay, and then this one, funding from family and friends. If they are supportive of you and if they have the money, then you can ask them to help fund your business or your product or the development of your product, right? But again, majority or most of the time, family and friends are not supportive, right? They do question your ability. They think you are not good enough, and in a way, I don't know if jealousy or envy plays a certain role, but there are sometimes it's human nature that they don't want to see other people becoming successful. So what they do is that they drag people down. But even so, if you are an entrepreneur, if you are a founder, if you have a good business idea that you want to pursue, then don't listen to them. Believe in yourself and just continue. If your product or business is going to solve a particular problem, then focus on that, right? There would be other people who would be interested, who would resonate with your idea, and who would be willing to fund your product or your business, right? But still, it's better if your family and friends would be supportive of you. But this one is also tricky because, here in the Philippines, we have a culture that children are expected to help out the family, and sometimes if they see, if you're a successful business person, sometimes it would be a little tricky or complicated. Sometimes it would complicate relationship, with family members and relatives, right? But so you have to be very careful with this part here. Okay, sometimes it could also destroy friendships or relationships if your idea fails, or if you're taking quite a long time, which is something they might not understand. So there is that, right? Okay, so bottom line, when you can avoid financing from a formal source, it will usually be more advantageous for your business. If you do not have family or friends with the means to help, that financing is likely the easiest source of funds for small businesses. Okay, as your business grows or reaches later stages of product development, it shows potential. Equity financing or mezzanine capital may become options. When it comes to financing and how it will affect your business, less is more, of course. Alright, so that's it for this particular video. Again, this is about the basics of financing a business. Alright, so that's it for this one. Thanks and bye.